Your mortgage payment is going up, not because the Federal Reserve raised interest rates, not because your credit score deteriorated, not because the housing market in your city shifted, because governments and institutions on the other side of the world, in Tokyo, in Beijing, in Frankfurt, in Riyadh, are quietly, methodically, and deliberately reducing their holdings of American debt. And the mathematical mechanism connecting their portfolio decisions to your monthly payment is something that almost no financial media outlet has connected clearly for ordinary Americans. Until right now, here's the number that makes this concrete before anything else. JP Morgan's own research team quantified this relationship explicitly. Every 1 percentage point decline in foreign ownership of US Treasury securities relative to GDP, roughly $300 billion in absolute terms, pushes US Treasury yields higher by more than 33 basis points. 33 basis points on a $400,000 mortgage, which is close to the median loan size in major American metropolitan markets, costs approximately $80 more every single month. That is $1,056 per year. Not because anything changed in your financial life, because the foreign institutions that have been subsidizing American borrowing costs for 30 years by buying US government debt are gradually, measurably stepping back. And foreign ownership of US Treasuries has already fallen from above 50% of the total market at its 2008 peak to approximately 30% today. That is not a one-year event. That is a 15-year structural decline that is now accelerating at the exact moment the US government needs to borrow more money than at any point in its history. This video is built entirely on sourced institutional data from JP Morgan, Deutsche Bank, Morgan Stanley, Bridgewater Associates, MSCI, Morningstar, the IMF, and live market pricing. Every number I give you has an institutional source, because this story is not a theory. It is already in the price of your groceries, the rate on your car loan, and the yield on the treasury bonds that set your mortgage rate. Let me show you exactly what happened, why it matters more than you were told, and what the institutions managing trillions of dollars are doing with their own money right now in response to it. In April 2025, something occurred in global financial markets that carried a technical name on Wall Street that most Americans never heard on the evening news. US stocks fell. US Treasury bonds fell, and the US dollar fell, all three, simultaneously, in the same week, from the same cause. That combination is called the triple red by market analysts, and financial analysts at MSCI confirmed it has occurred only twice in lasting form in the entire modern history of global markets, during the 1970s stagflation era and in the aftermath of the 1987 crash. To understand why this is alarming, you need to understand the script that global finance has followed for the past 40 years, without exception. When fear spikes globally, war, financial crisis, political shock, investors have always done one thing automatically. They buy US Treasury bonds and US dollars. Bond prices rise, yields fall, the dollar surges, and America's borrowing costs actually decrease precisely when the world is most afraid. This is the foundation of American financial dominance. The world's fear subsidizes America's borrowing. It has worked this way for 4 decades without a significant break. In April 2025, when the Trump administration's tariff announcement triggered global market panic, that script broke completely. The S&P 500 dropped 12%. Long-end Treasury yields spiked over 40 basis points in less than 2 weeks, rising above 4.50%. The dollar fell 6% simultaneously. $6 trillion in global market capitalization evaporated in days. And Deutsche Bank's global head of foreign exchange research published a note to institutional clients that contained 3 words that professional currency traders treat as a 5-alarm warning signal, rapidly de-dollarizing. Now, before we go further, where are you watching this from right now? Drop your city or country in the comments. The Recession Warnings audience is global, and I want to know where you're tuning in from, because what happened in April 2025 affected every country that holds dollars, and that is almost every country on Earth. In every prior tariff episode in modern financial history, tariffs strengthen the imposing country's currency. The textbook mechanism is straightforward. Tariffs restrict imports, money flows inward, domestic production becomes more competitive, the currency appreciates. April 2025 broke the textbook in a way that former Treasury Secretary Lawrence Summers described publicly in terms that should have been the lead story on every financial news outlet in America. Summers said US Treasuries were starting to trade like the bonds of an emerging market nation. That is not political commentary from a partisan critic. That is a former Treasury Secretary describing the actual market price action in the most liquid government bond market on the surface of the earth. The capital was not flowing inward when tariffs went up. It was flowing out. Foreign investors were not simply rotating from US stocks into US bonds the way they normally do during American market stress. They were selling US stocks, selling US bonds, and moving the proceeds entirely out of the United States into euros, into German government bonds, into Swiss francs, and into gold. That is capital flight. It is the phenomenon that financial crisis literature has documented in emerging market collapses. It is not supposed to happen to the reserve currency. At one specific moment in early April 2025, the 30-year US Treasury yield briefly exceeded the equivalent yield on Greek government bonds. Read that sentence one more time. American 30-year debt was priced by the global market as carrying more risk than the debt of a country that required 3 consecutive international bailouts between 2010 and 2018. Simultaneously, German government bonds were falling in yield as global fear money ran to them for safety, while US Treasuries were rising in yield as global fear money fled them. Germany, not America, was where the world parked its terrified capital during a global crisis week. That inversion, even if temporary, even if it lasted only days, is one of the most significant price signals in global fixed income markets in the past 20 years. One Treasury auction during that period showed domestic institutional buyers, U.S. insurance companies and pension funds, the institutions that are supposed to be the bedrock buyers of American government debt, absorbing just 6.2% of the supply. The historical average for that category of buyer is 19%. The people who were always at the auction stepped back, and the foreign buyers who have historically filled any gap in domestic demand did not show up to fill it. Then the episode calmed. The Trump administration paused tariffs. Yields fell back. The dollar partially recovered. Wall Street exhaled. And the consensus narrative that formed almost immediately was that Sell America was a one-week trade driven by a specific policy shock, not a structural signal about the dollar's global standing. That framing is dangerously incomplete. And the reason it is dangerously incomplete is that the exact same pattern returned. Not once, 3 more times. In January 2026, when news broke that the Justice Department had subpoenaed the Federal Reserve in what Fed Chair Jerome Powell publicly described as a political intimidation tactic, the dollar weakened against every major currency simultaneously, Treasury yields spiked, and gold hit a new all-time record above $4,600 per troy ounce on the same day. ING's currency strategist called it an exact reminiscence of the Sell America episode of the prior spring. The triple red fingerprint, stocks, bonds, and dollar falling together, appeared again. When Greenland geopolitical tensions escalated in January 2026, the Dow dropped over 800 points in a single session. The dollar index fell, yields spiked, and gold surged. Same fingerprint. A one-time event is a reaction to a specific shock. 3 episodes with the identical market fingerprint across 12 months, triggered by 3 completely different catalysts, is a pattern. And a pattern tells you something about the underlying structure that individual events cannot. The structure underneath these episodes is documented in the most granular institutional research available. JP Morgan found that foreign ownership of U.S. Treasury securities has fallen from above 50% of the total market at its peak around 2008 to approximately 30% today. That is a structural 20-year decline in the demand that has kept American borrowing costs artificially suppressed. Foreign bank accounts and institutions still hold more than $8.5 trillion in U.S. Treasuries in absolute terms, a number that is still large enough to matter enormously. But the direction of the trend has been consistently downward for 15 years without a single year of reversal. And the trend is now intersecting with a moment of maximum American borrowing need. The U.S. government is running an annual deficit approaching $2 trillion. The national debt stands above $36 trillion. The Congressional Budget Office projects deficits of comparable magnitude for the next decade without any credible fiscal consolidation on the horizon. That debt requires buyers at every Treasury auction, every week, every month, for the foreseeable future. The buyers who have historically underwritten that demand are reducing their exposure on a structural basis. The deficit requiring that demand is growing. The mathematical collision between those 2 trends is what JP Morgan's yield impact research quantified, and the output of that collision is paid for by ordinary American families in the form of higher borrowing costs on everything they finance. The dollar index fell approximately 11% in the first half of 2025 alone, the largest first-half decline since 1973. TD Economics confirmed the full year 2025 decline was approximately 10% against major currencies. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, wrote in his year-end reflection that 2025 was a year of big shifts in flows, values, and wealth away from the United States, with European stocks outperforming U.S. equities by 23% and Chinese stocks by 21%. He described the dollar falling 39% against gold in a single year. And then at Davos, in January 2026, standing in front of the world's top financial leaders, Dalio said directly and on camera, "On the other side of trade wars, there are capital wars, and maybe there's not the same inclination to buy U.S. debt." When the founder of the world's largest hedge fund says that publicly at the World Economic Forum, that is not a warning shot fired across the bow. That is the gun already firing and the smoke already visible. The Moody's credit rating downgrade that arrived in May 2025 made this structural dynamic formally and permanently worse in a way that most financial coverage treated as a one-day story rather than a permanent change in America's borrowing environment. On May 16, 2025, Moody's became the final major credit rating agency to strip the United States of its top-tier sovereign credit rating, citing the continued expansion of U.S. debt and an explicit lack of confidence that meaningful deficit reduction would result from any fiscal proposals currently under consideration. S&P had downgraded in 2011, Fitch downgraded in 2023. When Moody's fell, the United States became the only country in recorded history to hold the world's reserve currency while having been downgraded by all three of the major ratings agencies simultaneously. Credit downgrades do not trigger immediate fire sales of government debt. What they do is incrementally raise the risk premium that institutional investors require to hold that debt, which is a technical way of saying they put persistent structural upward pressure on yields that does not go away when the news cycle moves on. The dollar's share of global foreign exchange reserves has fallen to 56.9%, its lowest level since 1994, confirmed by the IMF's official currency composition data. That number was 71% in 1999. The decline from 71% to 57% over 25 years is not a collapse. It is a structural erosion. And it is the structural erosion, not a dramatic crash, that represents the actual mechanism by which American households pay a higher price. Every percentage point of reserve share lost is another increment of artificial demand removed from the Treasury market, which is another increment of upward pressure on the yields that set mortgage rates, auto loan rates, credit card rates, and the cost of servicing $36 trillion in existing government debt. Central banks globally have been buying gold at the highest annual pace since 1950 in 3 consecutive years, 2022, 2023, and 2024. JP Morgan's own 2026 research team set a gold price target of $5,000 per ounce by year-end, citing continued central bank purchasing, U.S. debt sustainability concerns, and Federal Reserve independence risks as the 3 primary drivers. Spot gold was already trading above $5,160 in early March 2026, having already exceeded JP Morgan's year-end target before the first quarter was complete. Gold returned 65% in dollar terms across 2025, outperforming the S&P 500 by 47 percentage points over the same period. These institutions are not buying gold because they think it is a good trade. They are buying gold because it is the asset that has maintained exchange value across every monetary transition in recorded history, and they are accumulating it at a pace that reflects a genuine institutional reassessment of what dollar-denominated assets will be worth in the monetary environment they expect to be navigating over the next decade. The Federal Reserve independence question deserves its own treatment because it is the dimension of this story that most financial coverage has handled most inadequately. Comments about the potential dismissal of Fed Chair Jerome Powell led to a 1.2% drop in the dollar within a single hour on July 16, 2025. One comment, 1 hour. 1.2% move in the world's reserve currency. When the Justice Department subpoenaed the Federal Reserve in January 2026, the combined simultaneous drop in the dollar, equities, and treasuries happened on a single trading day, the exact triple red fingerprint that had appeared in April 2025. RBC Capital Markets warned explicitly that markets would begin pricing in greater inflation expectations, a higher inflation risk premium, an elevated term premium if the Fed's independence came under further sustained pressure. An analyst at Invesco described U.S. assets as becoming more predatory in terms of the risks they carry for international holders. The reason Federal Reserve independence matters so acutely for the dollar's global standing is that the Fed's institutional credibility, its demonstrated willingness to fight inflation regardless of short-term political pressure, is the functional guarantee that dollar-denominated paper assets will not be deliberately inflated away to manage the government's debt burden. That guarantee is what separates the dollar from the currencies of high-debt emerging market economies that have lost reserve status in the past. Remove that guarantee credibly, or even threaten it convincingly enough that institutional investors in Tokyo and Frankfurt begin repricing the risk, and foreign holders of dollar assets face a scenario that institutional capital is structurally designed to exit before the damage fully materializes. Jerome Powell's term as Fed chair expires in May 2026. The appointment of his replacement is, according to every institutional FX research team currently publishing on this question, the single most important U.S. financial event of the year for dollar credibility. A credible inflation-fighting replacement appointed, and dollar confidence stabilizes around its current level. A politically compliant replacement who signals willingness to cut rates regardless of inflation conditions appointed, and the Sell America pattern almost certainly returns with force. This time, without the temporary calming that followed the tariff pause in April 2025. Now the counterargument deserves honest examination because the strongest version of the bull case for the dollar is not weak, and dismissing it would be analytically dishonest. The dollar is not collapsing. That statement deserves to be made clearly and without qualification. The IMF data has the dollar at 56.9% of global reserves, still more than double the euro at roughly 20% and vastly ahead of the yuan, which sits below 3%. The Bank for International Settlements data shows the dollar on one side of approximately 89% of all global foreign exchange transactions. The infrastructure of global finance, SWIFT, correspondent banking networks, commodity pricing contracts, international debt markets, is built around the dollar in ways that cannot be meaningfully restructured in years or even in a decade. TD Economics confirmed that the 2025 decline in the dollar's reserve share was driven almost entirely by the dollar's depreciation, reducing the mechanical value of dollar-denominated reserve assets, not by central banks actively selling Treasury securities at scale. Genuine outright dumping of U.S. government debt has not occurred. Foreign investors poured more than $300 billion into U.S. assets in August and September 2025, easing immediate fears of structural exodus. The safe haven demand for the dollar, while episodically damaged, has not permanently disappeared. Here is the precise distinction that makes the dollar's fine argument incomplete without being wrong. The question has never been whether the dollar survives. It will. The question is the cost at which it survives. A dollar that commands 57% of global reserves instead of 71% needs to offer marginally higher yields to attract the marginal buyer of U.S. Treasuries. A dollar facing persistent $2 trillion annual deficits, a triple credit agency downgrade, repeated institutional challenges to Federal Reserve independence, and a structural 15-year decline in foreign demand cannot borrow at the same cost it borrowed at when all of those structural factors were moving in the opposite direction. The exorbitant privilege, the term economists use for the extraordinary benefit America receives from being the world's reserve currency, is not binary. It does not exist fully or disappear entirely overnight. It erodes incrementally, and every increment of erosion is paid for by American households in the precise form of slightly higher mortgage rates, slightly higher auto loan rates, slightly higher credit card rates, and a slightly larger share of the federal tax revenue consumed by interest payments on existing debt rather than by services that American families actually use. What the institutions managing the world's largest pools of capital are doing right now with their own money is the most reliable signal available about where this story is going, because large institutions do not communicate their genuine views through press releases. They communicate them through capital allocation. The MSCI Emerging Markets Index returned approximately 27% in 2025, its strongest performance since 2009. European equities outperformed U.S. equities by 23% over the same year. Gold returned 65% in dollar terms. The dollar index fell approximately 9.4% for the full year, its worst annual performance since 2017. Morgan Stanley's research team has projected the dollar loses another 10% against major currencies by the end of 2026. The G10 Foreign Exchange Research Team at MUFG projects a 5% dollar index decline in 2026, with EUR-USD reaching 1.24. The Federal Reserve is cutting rates while the Bank of Japan is raising them, a rate differential compression that directly reduces the yield advantage that has supported institutional dollar demand for the past several years. Every institutional research team with serious quantitative macro analysis is pointing in the same direction. Not toward collapse, not toward crisis, toward persistent structural accelerating weakness in a U.S. economy that simultaneously needs to roll over nearly $10 trillion in Treasury debt in the near term, fund a $2 trillion annual deficit indefinitely, and maintain the confidence of the foreign investors whose demand for that debt is the single largest external determinant of what Americans pay when they borrow money for a house, a car, or business. The practical implication for individual American investors and households is important to state clearly, because most of what gets written about dollar weakness is aimed at institutional traders, with hedging tools that ordinary Americans do not have access to. Most individual Americans have their income and their expenses both denominated in dollars. A 10% dollar decline against the euro does not land on their doorstep as a direct daily experience. It filters through gradually via imported consumer goods inflation, via the cost of international travel, and via the performance differential between a purely domestic U.S. portfolio and a globally diversified one that captures the outperformance of non-U.S. markets during a dollar weakening cycle. Morningstar's analysis of global currency valuations found that among 34 major developed and emerging market currencies tracked, only 9 are currently more overvalued than the U.S. dollar, meaning the dollar still trades at a premium to most global peers, but that premium has been compressing for 2 years. For any American with a retirement account or a savings portfolio that is entirely concentrated in US dollar-denominated assets, the arithmetic of a structural dollar weakening cycle is simple and does not require forecasting ability to understand. A portfolio that was 100% concentrated in US assets from 2010 to 2024 performed exceptionally well during the dollar's structural bull market. That same portfolio in a structural dollar weakening environment will underperform a globally diversified equivalent by precisely the magnitude of dollar depreciation multiplied by the share of non-US exposure the diversified portfolio carries. That is not a forecast. It is arithmetic, applied to the return data that 2025 already produced. The dollar index was down 9.4% in 2025. Gold was up 65%. European equities outperformed US equities by 23%. The MSCI Emerging Markets Index delivered its best year since 2009. Those numbers are not projections. They are the returns that already occurred. And Morgan Stanley, MUFG, TD Economics, and JP Morgan's own foreign exchange strategists are all projecting the same directional trend continuing through 2026. The honest verdict for every American watching this is the following. The dollar is not dying. The dollar is weakening structurally and persistently across every indicator that institutional analysts with genuine analytical resources are tracking. The American households most exposed to that weakening are the ones with all savings and retirement assets concentrated exclusively in US dollar-denominated instruments at the exact moment when global diversification is delivering measurably superior risk-adjusted returns. The American households most protected are the ones who understand that the 15-year dollar bull market that ran from 2010 to 2024 was historically exceptional, driven by a specific combination of post-financial crisis safe haven flows, the shale energy revolution, and relative U.S. economic outperformance, and that the reversion toward a more normal multipolar currency environment that was always the long-run trajectory has now visibly begun. 4 separate Sell America episodes hit financial markets in 12 months, triggered by 4 completely different catalysts. A tariff announcement, a Fed independence threat, a geopolitical tension, a credit rating action. 4 different triggers. One identical fingerprint every time. Stocks, bonds, and dollar falling together. The market is speaking in the only language it has, price. And what it is saying, consistently and repeatedly across 12 months of evidence, is that the structural assumptions underlying 40 years of unquestioned American financial dominance are being actively, visibly, and institutionally reassessed. Subscribe to Recession Warnings right now. This channel exists to deliver exactly the kind of connected, sourced, honest financial analysis that takes institutional research and makes it legible for every American who deserves to understand what is happening to their money. Share this video with one person in your life who still holds a 100% dollar-denominated portfolio and has never seriously considered what a 10% annual dollar decline does to the real purchasing power of those savings over a decade. Because the institutions managing the world's sovereign wealth are already repositioning, and the window to act before that repositioning becomes consensus is, by definition, closing.